let me ask you something that might just keep you up at night. What if trying harder, what if all that effort you're putting into being a great investor is the very thing that's tanking your returns? Yeah, let's get into it.
So check this out. There was this massive study of over 66,000 brokerage accounts. And what it found was, well, it's staggering. The people who traded the most, the ones glued to the news, the ones who felt the most on top of things, they didn't just underperform the market. They got absolutely crushed. We're talking returns that were 6.5% lower than the market average every single year. That's not a small mistake. That is a financial catastrophe in slow motion.
And this leads us to a really uncomfortable question, doesn't it? What if all those books, all those hours watching financial news, all that hard work, what if it's not just not helping? What if it's actively making you poorer?
All right, let's trace this back. Where does this all go wrong? It starts at that moment when investing finally starts to, click. But that's the exact same moment a psychological trap snaps shut.
I want you to think back for a second. You read a few books, you finally figured out what a PE ratio is, you made a few trades, and hey, some of them actually worked out. And you started to feel it, right? That feeling of, okay, I get this. I'm not just guessing anymore. That feeling, that is precisely where the danger begins.
This slide, oh man, it just lays it all out, doesn't it? This is your ego versus the cold, hard data. When a stock you pick goes up, your brain screams, see, I'm a genius. But when it goes down, oh, well, that was the Fed's fault, or bad luck, or some headline you couldn't predict. You're suffering from confirmation bias. You see, your wins feel like proof of skill, but you explain away your losses, and the result? Your confidence just skyrockets way, way faster than your actual skill.
And here's the bottom line. That feeling of being smart, that unearned confidence, it isn't just a quirky personality trait. It has a price tag. It's a real cost that shows up in your brokerage statement, measured in actual dollars and cents.
So why does our brain do this to us? Let's pull back the curtain and look at the actual science here, because this isn't just a hunch I have. It's one of the most well-documented and, frankly, most expensive bugs in our human operating system.
It's called the overconfidence bias. It's our brain's built-in tendency to believe we're better at predicting the future than we actually are. And when it comes to money, this one single bias is probably responsible for burning more holes in more pockets than any other. Landmark research from Dunning-Kruger found something that's, well, kind of chilling. For anyone who's not an absolute expert, our confidence grows exponentially faster than our competence. So imagine what you actually know is this small, solid circle. But what you think you know, that's a giant expanding bubble around it. And that gap, that space between reality and your ego, is where all the bad decisions live.
This effect is so real and so predictable that it even has a nickname. Researchers call that early peak, where your confidence is at its absolute highest but your skill is still incredibly low, Mount Stupid. It is, without a doubt, the single most dangerous place for an investor to be.
Now, look, this isn't just some abstract psychological theory. We have seen this play out in the real world with absolutely devastating results. Let's talk about a war story, the dot-com bubble. In the late 90s, the NASDAQ went on an absolute tear. Just a 400% rocket ship to the moon. An entire generation of brand new investors piled in, totally convinced they had cracked the code on the new economy. In March of 2000, they felt like absolute geniuses. And then, the roller coaster crested the hill. Over the next 2 years, the market collapsed, wiping out nearly 80% of its value. And here is the crucial part, a warning for all of us today. The financial news media back then, they weren't a voice of reason. The editorial oversight was just gone. Instead, they acted as pure gasoline on the fire, splashing stories everywhere about tech geniuses and teenage day trading millionaires. It was an echo chamber that told everyone exactly what their overconfident brains wanted to hear. You're right, you're a genius, keep going. Based on my research, that era gives us the perfect A/B test. You have the active, ego-driven trader chasing hot stocks, convinced they were smarter than everyone else. They were trading in and out, racking up fees. When the crash came, they were obliterated, utterly wiped out. Now compare them to the boring, data-driven investor who just bought a simple index fund and did nothing. Sure, they lost value on paper, but because they held on, they recovered everything and then some, compounding their wealth for the next 20 years. Okay, that was the problem, the diagnosis. It's a little bleak, I know. But here's the good news. There are simple, powerful tools you can use to defend your portfolio from the most dangerous person you know, you. Let's build your new toolkit.
In my view, these 3 things are non-negotiable.
First, start a prediction journal. Every time you make a move, write down why you're doing it and what you expect to happen. Then, 90 days later, go back and read it. It's a brutally honest mirror of how good you actually are. Second, write a premortem. Before you buy anything, force yourself to write down the top 3 reasons it will most likely fail. This short-circuits that feel-good confidence loop. And finally, set a hard limit. Decide that only, say, 10% of your portfolio is play money. The other 90%, it goes in a boring, low-cost index fund, safe from your own best ideas.
If you walk away with just one single idea from this whole explainer, please let it be this. Your goal is not to feel more confident. Your goal is to get brutally honest about the gap between how confident you feel and how accurate you are. And then you let the size of that gap determine how much money you put on the line.
So, let's wrap this up. 1. Overconfidence makes you trade more, and trading more makes you earn less. Simple as that. 2. Remember, mount stupid. The point where you feel the absolute smartest is often when you are the most vulnerable. And 3. A journal, a premortem, and a hard cap on your fund money are your absolute best defenses against your own brain.
Subscribe to Money Psychology Explained if you think my video was useful and want to keep learning how to make smarter financial decisions with confidence. Don't forget to like, share with your friends, and drop a comment below.
And one last thing. If hearing about this bias made a little light bulb go off in your head, if it made you think differently about your own decisions, do me a favor and share this with someone in your life who really needs to hear it too. Thanks for watching.